You need to see this report that has a price target for Ethereum of $706,000 per ETH. Right now, serious investors everywhere are waking up to the fact that Ethereum is not just another coin. It's the fuel of the digital economy, the collateral of the on-chain world, and the reserve asset of the future. Institutions are building on Ethereum, companies are stockpiling ETH, and trillions of dollars in assets are being tokenized on its rails. Bitcoin may have proven the case for digital gold, but Ethereum is now going further. It's programmable, it's deflationary, and it's already the foundation of stablecoins, DeFi, and tokenized treasuries. The market hasn't priced any of this in yet, which is why Ethereum today represents the biggest asymmetric bet in finance. The opportunity is rare, the upside is massive, and the window is shrinking fast. This is the bull case for Ethereum, drawn from the bull case for ETH report published in June 2025 by leading Ethereum researchers, investors, and builders. In this video, I'm going to break down why Ethereum is being called the digital oil of the global economy, why analysts say it's already a reserve asset in the making, and how its value could ultimately be repriced as high as $706,000 per coin. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin. Before we dive into valuation frameworks and price projections, we first need to understand what Ethereum actually does in 2025. The June 2025 report, the bull case for ETH, describes Ethereum not as just a cryptocurrency, but as digital oil powering the on-chain economy. This distinction is critical because Bitcoin has succeeded as digital gold, a scarce monetary reserve. But ETH is more than a static store of value. It is consumed, staked, burned, and stockpiled. Every stablecoin transfer, every DeFi transaction, every piece of tokenized collateral requires ETH to move. That is why analysts increasingly call it the economic engine of the digital world. ETH's design makes it uniquely suited for this role. It is fuel for computation, as every transaction and smart contract execution consumes ETH and permanently burns a portion of supply. It doubles as pristine collateral, securing stablecoins, real-world assets, and DeFi applications with no dependence on sovereign issuers or corporate entities. At the same time, ETH offers native yield through staking, making it a productive financial instrument unlike Bitcoin, which sits idle. This multi-layered utility gives ETH both monetary and industrial value, something no other digital asset combines at scale. As adoption accelerates, Ethereum's function as a settlement layer ensures ETH will continue to gain monetary premium. Institutions and sovereigns already hold ETH as a strategic reserve asset, a trend the report highlights as the beginning of a stockpiling race. In a tokenized economy worth tens of trillions, ETH will be the indispensable resource, just as oil was to the industrial age. That's why ETH is best understood as the backbone commodity of the digital economy. With its deflationary supply dynamics and expanding role in global settlement, it is positioned to appreciate dramatically as adoption compounds. Now that we've established ETH as digital oil, the next step is to examine its monetary design, a system deliberately engineered to be simple, transparent, and sustainable. Coming out of its role as digital oil, we need to understand why ETH's monetary structure is unlike anything else in finance. The bull case for ETH report emphasizes that Ethereum's supply mechanics are designed with clarity, predictability, and sustainability in mind. While traditional commodities rely on extraction and fiat currencies rely on central bank discretion, ETH's issuance and burn are encoded at the protocol level. That transparency makes it a monetary system built for long-term resilience. At its core, Ethereum employs a principle called minimum viable issuance. Validators who secure the network receive newly issued ETH, but the issuance follows a formula that keeps inflation extremely low. Even under a theoretical maximum where 100% of ETH is staked, supply growth would be capped at 1.51% per year. In practice, net issuance since the 2022 merge has hovered around just 0.09% annually, far below Bitcoin, gold, or fiat money. This structure creates an environment where ETH is not just scarce, but potentially deflationary. The burn mechanism compounds this effect. Every transaction on Ethereum consumes ETH, and roughly 80% of the fees are permanently destroyed. As usage rises, so does the burn rate, pushing net issuance towards zero or even negative. Unlike oil, where higher demand leads to higher production, ETH's supply cannot simply expand to meet demand. That means periods of network activity translate directly into supply shocks, intensifying ETH's scarcity premium. Another key advantage is staking yield. ETH is not inert like gold. It can be staked to secure the network and in return provides a yield that rises as the economy built on Ethereum grows. This makes ETH both a monetary asset and a productive financial instrument, something that attracts institutions looking for yield without counterparty risk. These mechanics, transparent and programmatic, give ETH an unparalleled position as a sustainable monetary asset. Where Bitcoin risks a long-term security crunch once issuance ends, Ethereum's design keeps security strong without runaway inflation. Now that we've laid out how ETH's monetary system works, the next question is why the market has not yet recognized its superiority, and we'll answer that now by understanding why ETH has lagged behind Bitcoin and why that gap represents opportunity rather than weakness. To understand the opportunity ahead, we first need to ask why ETH has underperformed Bitcoin in recent years. From September 2022 to today, the ETH-BTC ratio has collapsed from 0.085 to around 0.041. That puts Ethereum close to multi-year relative lows, levels not seen since the early days of DeFi and before stablecoins and tokenization made it indispensable to global markets. Back then, many assumed Ethereum had peaked and would fade away. Yet today, Ethereum anchors over 80% of tokenized assets and secures more than $767 billion across its ecosystem. The gap between its adoption and its relative price performance has never been wider. The report explains that the gap comes down to narrative. Bitcoin is simple, universally understood, and institutionally accepted. It is digital gold, a scarce reserve currency outside government control. Meanwhile, Ethereum is more complex. It isn't just a store of value, it is programmable money, a settlement asset, collateral for DeFi, yield-bearing through staking, and the foundation for tokenized real-world assets. Its utility spans finance, identity, infrastructure, gaming, and AI. That complexity has made ETH harder for institutions to categorize, which slows the process of repricing it as a reserve asset. But that complexity is precisely where the opportunity lies. Each combines the scarcity of gold, the productivity of bonds, and the strategic importance of oil. It is not one-dimensional like Bitcoin. It is a multi-layered asset whose value grows as Ethereum becomes the operating system of the digital economy. Markets are slow to price in assets that don't fit neatly into existing categories, but when they do, the repricing can be explosive. This mispricing has created one of the rarest setups in global finance. Bitcoin has already had its repricing moment. Ethereum's is still ahead. With that context in place, let's examine how ETH should actually be valued, and why traditional methods miss the mark when applied to Ethereum's monetary design. Now that we've seen why ETH has lagged Bitcoin, the next step is to look at how Ethereum should actually be valued. This is where the report makes a decisive point. ETH cannot be treated like a tech stock. Many analysts mistakenly tried to apply discounted cash flow models to Ethereum, measuring future fee revenues against today's price. But that approach fundamentally misunderstands ETH. It is not a company, it is a commodity asset with unique monetary characteristics. Digital oil that powers computation and settlement across the world's financial internet. Like oil, ETH is consumed with every transaction. Like gold, it is a neutral, non-sovereign store of value. Like bonds, it offers yield through staking. No single discounted cash flow model can capture that combination. Instead, the right approach is to compare ETH to global reserve assets, commodities, and monetary instruments. When viewed this way, the upside becomes staggering. The report highlights several valuation frameworks. First, the oil benchmark. Proven oil reserves are valued around $85 trillion globally. ETH functions in an almost identical role for the digital economy, stockpiled and consumed as fuel. Second, the asset tokenization benchmark. With global wealth estimated at $500 trillion, even a conservative 10% tokenization rate would put more than $50 trillion of assets on Ethereum. ETH, as the settlement and collateral asset, cannot remain at a market cap of only $300 billion in that scenario. Third, ETH as neutral, pristine collateral. In the Ethereum economy, ETH serves the role US treasuries play in traditional finance, but without counterparty or sovereign risk. Finally, ETH's store of value properties align it with gold, which holds a $22 trillion market cap as a reserve asset. Taken together, these frameworks reveal that ETH's potential value dwarfs its current market pricing. If repriced alongside other reserve assets, ETH could be worth hundreds of thousands of dollars per coin, with the report pointing to a long-term target as high as $706,000. Understanding these frameworks sets a stage for the next step, placing ETH alongside other global reserve assets and seeing how it compares head-to-head. Having established why discounted cash flow models undervalue ETH, the report moves into direct comparisons with global reserve assets and breaks down how Ethereum could actually be worth $706,000 per Ethereum. This is where the bull case becomes undeniable. When ETH is analyzed against the world's most important stores of value and collateral assets, its long-term potential is measured not in billions but in tens of trillions. Start with oil. Global proven oil reserves carry a valuation of about $85 trillion. ETH plays the same economic role in the digital economy, stockpiled as reserves and consumed as fuel for computation and settlement. Unlike oil, however, ETH supply is programmatically capped in issuance and deflationary under high usage. That makes its scarcity profile even stronger. Now, consider gold, worth roughly $22 trillion. ETH shares gold's core properties: neutrality, non-sovereign status, and monetary premium. But it goes beyond gold by offering yield through staking and utility as collateral. Where gold is inert, ETH is productive. Next is the global bond market, valued at over $140 trillion. In traditional finance, bonds provide collateral for liquidity and yield for investors. In Ethereum's ecosystem, ETH plays this same role as pristine, neutral collateral, a foundation upon which stablecoins, DeFi, and tokenized assets rely. The difference is that ETH does this without counterparty or default risk, making it structurally superior in a world where trust in sovereign debt is declining. Finally, compare ETH to global M2 money supply, around $93 trillion. ETH is increasingly used as a settlement asset and base money for the on-chain economy. As tokenization accelerates, ETH will function like a digital monetary base layer, similar to how fiat liquidity underpins traditional systems. Averaging these benchmarks produces a long-term valuation around $85 trillion for ETH as an asset class. That translates to about $706,000 per coin. Even short to medium-term projections of $8,000 and $80,000 imply market caps of $1 trillion and $10 trillion respectively, still far above current levels. With comparisons this powerful, the next question becomes, what catalysts will actually drive ETH to reprice from today's misvalued state toward these levels? Now that we've seen how ETH stacks up against the world's major reserve assets, the obvious question is what will actually drive the market to reprice it? According to the bull case for ETH report, several catalysts are already in motion, and together they form a setup unlike anything else in global markets. The first catalyst is the surge in tokenization. Ethereum already secures more than $767 billion in assets, and institutions like BlackRock, JP Morgan, and Fidelity are issuing tokenized treasuries and funds directly on its rails. This is only the beginning. As trillions of dollars migrate on-chain, the demand for ETH as collateral and settlement fuel will accelerate dramatically. The second catalyst is staking yield and ETFs. With spot ETH ETFs now live and the imminent rollout of staked ETH ETFs, institutions are about to gain easy access to ETH's native yield. This makes ETH one of the few assets that combines monetary premium with income generation, something bonds once offered but with far higher risk today. Institutional appetite for yield-bearing assets will translate directly into increased ETH demand. Third is strategic stockpiling. The report highlights the creation of a strategic ETH reserve with nearly $2.5 billion already publicly disclosed. Applications, DeFi protocols, and even sovereign entities are accumulating ETH as a treasury-grade reserve. Unlike Bitcoin, which sits idle in treasuries, ETH can be staked, deployed as collateral, or integrated into financial infrastructure. That makes stockpiling ETH not just defensive, but productive. Finally, there's institutional treasury adoption. ETH's neutrality, scarcity, and programmability position it as a preferred reserve asset for institutions operating on-chain. Once corporations and sovereigns adopt ETH for treasury management, the repricing momentum will be irreversible. These catalysts together create the conditions for ETH to move rapidly from being misunderstood to being indispensable. The market is not yet pricing this in, which is why the current setup is so asymmetric. With catalysts for repricing now clear, we need to zoom out and look at the bigger picture. Why Ethereum itself is the infrastructure that makes all of this possible. According to the bull case for ETH, Ethereum is more than a blockchain. It is the most reliable settlement layer for the digital economy, a public utility that combines decentralization, security, programmability, and uptime. ETH gains value not just because people speculate on it, but because Ethereum has become indispensable infrastructure. Ethereum's design offers several unmatched advantages. It has never gone offline since its launch in 2015, even through major protocol upgrades like the merge. Its validator set is globally distributed and accessible, ensuring neutrality and resilience. Over 81% of tokenized assets exist on Ethereum, and 60% of all stablecoins use its rails. Its ecosystem secures more than $767 billion in assets, with institutions from BlackRock to Deutsche Bank building directly on its platform. No other blockchain comes close in credibility or scale. The roadmap for scalability ensures this dominance will only expand. Layer 2s are already delivering high throughput while anchoring security to Ethereum's base layer. Interoperability upgrades are transforming what was once a fragmented ecosystem into a seamless experience, giving users the feel of a single unified chain. Meanwhile, account abstraction has unlocked mainstream-friendly features like biometric sign-ins and smart wallets, closing the gap between crypto and fintech. Perhaps most important is regulatory clarity. With ETH confirmed as a commodity and ETFs approved, institutions now have the green light to build and accumulate. What was once hesitation has become acceleration. Add in the rise of AI-powered agents that will require programmable settlement and trustless infrastructure, and Ethereum stands out as the only platform capable of supporting a machine-native economy. All of this underscores why ETH is not just another asset, it is the reserve fuel, the collateral, and the monetary layer of a new global system. Ethereum is the infrastructure and ETH is the lifeblood. Which brings us back full circle. Ethereum's bull case is not speculative hype because it is the inevitable repricing of the digital economy's foundational asset. Ethereum's path to repricing is already underway, and the key is spotting the signals before the market catches on. So if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.